Hi, Abhisar. Am I audible?
Yes, you are audible. Hope I'm audible too.
Yes, you're audible clearly. So, welcome to the podcast, Abhisar, and we'll be starting in a couple of minutes. Let people settle down, and meanwhile, let me do away with the disclaimers first. Uh, Those who are joining us regularly, they know, and those who are joining for the first time, this is again a purely educational session wherein we will have an interactive session with Abhisar and we'll try to delve into the nuances of investing and the framework they use at Monarch Capital. And definitely, we will allow you to ask questions in the end. And definitely, the questions should be much thought after rather than simply asking any buy sell recommendation because we won't be answering those questions. And during the course of this session, if there would be any examples, be it the past case studies or recent examples, by no mean that is an endorsement on buy, sell, or hold recommendation. These are individual views, and you can take that with a pinch of salt. The idea is to drive these sessions so as to give you a starting point for you to think upon. And definitely for investment, you can always consult your financial advisors. So, Abhisar, let me take the opportunity, audience, to introduce our guest for today. So, today we have with us Abhisar Jain. He's head and fund manager at Monarch Capital AIF. He's got 16 plus years of rich experience, and by education, he's an MBA in finance from SP Jain Center of Global Management, and is a CFA charter holder from US, and he has also been awarded 40 under 40 alternative investment professionals in India in the year 2022 award by Equalify. And he joined Monarch Capital in the year 2019 and has been very instrumental in starting the AIF division and scaling it to presently 1000 CR plus in less than 5 years, and we believe he will continue to scale new heights every year. So, Abhisar, very warm welcome to the podcast. And just in case I missed anything on your introduction, I would request you to suffice that in your opening note. Over to you.
Thank you. Thank you so much, Prince. No, I think that was a kind introduction. So, whenever we are ready, Prince, we can start the session, please.
So, Abhishar, is always interesting to know about the starting point. So, I would request you to tell us about how did your market journey start? What was the starting point, and how it has evolved over a period of time?
Yeah, sure. So see, my market journey started immediately after my post graduation, which was MBA in finance, and from there, straight from campus, I got an opportunity to work as an equity research analyst on the sell side. This was 16 years back. Now, once I got into that role, I really kind of, enjoyed doing the research on specific companies and understanding how the business model works and what it takes to, kind of build a successful business which can compound capital over long term sustainably and is not, something which is just a short term gain and then back to square one. So, Prince, it was very interesting, to do that kind of analysis in my initial years and get a hang around it. I started my career in 2008, which, happened to be the subprime crisis and Lehman crisis period. So I also kind of learned at that time that it's not just one-way street in the market, and as much as we like the gains, but the losses can be, also damaging. So once I understood, that process, then over the next 5 to 6 years, kind of, I had it very clear in my mind that I wanted to do this as a full-time career and also as a fund manager managing real money. So that kind of something which I understood. after being 5 to 6 years into my role. And I would like to tell you and my listeners here that what attracted me towards being a fund manager um, and as an investor on a whole was that generally we as fund managers don't have any retirement age. You know, you can do this for as long as you live if you're passionate and if you're mentally active. This is proved by famed fund managers like Warren Buffett, Charlie Munger, who have been able to do this well into their 90s also, right? And there are many fund managers who practice investing today late into their 70s. So this is quite fascinating, you know. This fascinated me a lot because you will have very few businesses or career paths where you'll have no retirement age. In fact, you can get better with age in this profession because you would have seen then lot of cycles and all. And this is what Prince led me, after being 10 year into my sell side role, around 2019 is something when I took this challenging role at Monarch AIF, where I was given the responsibility to be the fund manager as well as set up the desk from scratch. And that's when, I kind of jumped sides from sell side to buy side. And in the last 5.5 years, thankfully, we have been able to kind of scale up our AIF business, which is running long only equity funds to around 1,000 crore AUM. And, yeah, I'm quite geared up to hopefully have several decades of investing career ahead of me.
Great. So, Abhisar, how had been the transition? Means being in research role is one responsibility, but when you move full time into fund management, there are additional responsibilities as well. And when you start something from scratch, it takes a lot of effort to find the right team and right people who can, match the frequency, right? Because the synergy is very important when you are handling public money. So, how had it been for you?
Yeah, that's very right. Actually, Prince, I have been lucky in this aspect to kind of have a ecosystem at Monarch, which has been tuned to managing money on both long-term basis and with patient capital. I didn't mention, but actually all of this 1,000 crore AUM that we have raised at Monarch AIF is all complete direct money. Nothing has come from intermediaries. So what has that happened is that we have done only fundraisers once in a while, and in this 5 year period, slowly from scratch, I have been able to kind of build the team of research at our firm on a gradual basis. For the first 1.5, 2 years, we were with very skeletal 2, 3 member team, but right now we have more than 10 members in research. And it's about, the philosophy and the investment strategy of what you believe in. And once that is kind of percolated in the team and you follow it through all kinds of market scenarios, then I think, Prince, that becomes more of a culture and in the organization, which everybody kind of gets linked to. So while it has not been easy, but I think it is not something which is incredibly difficult. On the switch from sell side to buy side, it's very different ball game altogether because, of course, when you are in the sell side, you are recommending to someone, whereas on the buy side, we are investing the hard-earned money, both of us as well as of our investors, and there is a lot of fiduciary duty around it. And thankfully, we had thought of it before starting, to take our AUM. So first 1 year, we didn't take any AUM, in fact, Prince, from 2019 to late 2020. And that's when I think we kind of put those nut bolts in place and hence been able to kind of do okay till now.
Great. So, Abhisar, what's your take on the current euphoric sentiments in the market, barring this budget certainty? For that, I'll come to you on another question. But the current euphoric sentiments in the market and how you are positioning yourself.
Yeah, Prince, this is quite interesting as well as quite incredible. The market has been actually very, very kind to investors of late, and that period has been very long. Actually, now it has been a very kind market since almost COVID lows. So I think the valuations today are looking stretched in many parts of the market, no doubt about it. We also feel that markets have become very fast-paced in nature, and the ample liquidity which is there in the market, and particularly in the last 6 to 12 months, it has seen many gravity-defying moves in stocks in several sectors. So I think, in my view, this phenomenon has been quite incredible. In fact, dare I say, even nonsensical in some cases, where the stocks may double up within 1 month, 2 months, even from a very high valuations in difficult sectors where working capitals have generally been very high or dependence on governments have been very high, but stocks have done what they have done. So the domestic flows into markets have been very solid even on bad days, like we saw on 4th June. They obviously that flow proved right in till now. That's a good thing, but the flows have been very solid, and all the supply that comes into the market gets absorbed by these flows. However, Prince, now we are seeing that supply of paper in the market is coming at a ferocious speed. It's coming at a ferocious speed, be it new QIPs, be it IPOs, be it promoter selling. It is increasing every month. And this may lead to, the market finding its right equilibrium. I don't know the exact period. It may take 1 month, 3 months, 2 quarters, but I think that period is something which we are approaching. So that's on the sentiment of the euphoric sentiment that you talked about. Having said that, amidst this widespread euphoric atmosphere, one good thing in this market has been that in the last 3 to 4 years, when this sentiment has prevailed and we have moved up 3x from COVID lows from 8,000 Nifty to 24,000 Nifty today, fundamentals have kept pace. It's not as if, I'm building castles in the air. Fundamentals have improved in several pockets. You do get, visibility of sustainable or durable growth in many pockets in the market. And this has been led by long-term reforms in various sectors, good corporate health, balance sheet cleanup in both banking side and on the corporate side as well, and a good solid GDP growth. So that has, of course, happened. And even though the market is very euphoric, there are some pockets which have not participated in the rally that much. So you do get, some pockets of value, which I think going forward in our discussion we'll come to. So you also asked us our positioning, how are we positioning in this kind of, setup and a unique market wherein a lot of crazy stuff is also happening, and a lot of sectors are also not maybe fully participating in that rally. So see, Prince, what we do is we have a well-defined investment strategy and philosophy in place on a bottoms-up basis. So we follow that for any stock selection anyways. But we do study sectors on top-down basis and look for extremely favorable setups and tailwinds from a sector perspective. These might have to do with good macros, government policies, or long-term visibility. Thankfully, in India, there are now many, many sectors which fit that top-down criteria. So then our job is basically to tie this up with the deep bottoms-up analysis to complete the loop. So even if you have a strong view on any sector, like say hospitals, right? We feel that it's a very good space, given the dynamics, given the way the healthcare is needed in the country of 140 crore people, the stock selection within that space will still be a good bottoms of work and risk reward attractiveness in each of those stocks. And lastly, while it is tough to find very cheap stocks currently, and we continue to treat cautiously in this market, but we do find pockets of opportunities where we can deploy money with an IRR of at least 15 to 20%, if not more.
So, as we speak, the topic for today is again investing prudently, although you highlight some nuances to it. But if somebody, let's take if some incremental money is coming to you, or if, say, in public domain, anyone want to invest their fresh money. So, do you believe this is the right time, or there are some nuances to it, as you were saying that the market might take some time, but there is some, if not the big correction, but time correction might happen from here. So do you buy that statement, or how you suggest on this?
Yes, Prince. So, see, this question of and the discussion of our topic of how to invest prudently in this current market. So it's, to be very frank, it's a very tough market to invest rationally. Because if you do invest rationally, you may end up underperforming for some time. Okay. Currently, the market is rewarding aggression, and the lines between aggression and irrational behavior are getting blurred. Also, this has been going on for too long. So sometimes certain themes, are being bid up to an irrational level, and the assumptions that are being made on the earnings and the profitability are too long way into the future, where there will be bumps in between, and things may or may not be as simple as that. So I think it's the kind of market right now where you need to little bit sit back and allow your peers or even your neighbors to make more money than you, right? So I'm not saying just book profits and run away from the market, but I'm just trying to say that you don't need to do all the irrational stuff which may be making the maximum money right now. Okay, Prince, I would like to tell you one quote which I really love. Okay, and this goes like this: fighting your emotions in investing is one battle which never ends but can be won every day. So basically, when we go into the markets every day, we get the quote right from the market, and that creates a lot of emotions around investing, and it's a battle which I think which never ends because market opens every day, but you can win over it every day. So I think in current times investors have to fight their emotions more than ever, not to make the big mistakes. They need to stay prudent. Currently, risks are there in the market, but neither many people are flagging those risks, or neither they are highlighted much because of the widespread buoyancy. In our view, long-term fundamentals in Indian markets are very solid, Prince. No, make no mistake. Okay. But there are near-term risks in our view, which are stemming from both earnings growth being slower than what is penciled in for FY25 and 26, as well as the valuation multiple on those earnings are already quite high due to continuous dose of uninterrupted liquidity. So my sense right now is to not take the money off the table, but incrementally deploying the money more cautiously than what you were deploying, say, 1 quarter, 2 quarter back, or even 1 year back. Okay. And I think both the point that I just said earlier about a lot of supply hitting in the market now on a monthly basis, that supply velocity is increasing, and the earnings growth in the near term may kind of show you a color which is little lower than what you have already penciled in. Those two things could, lead the market to spend some time in this range, like you mentioned, whether the time correction can come in or even an absolute correction of some extent. I rule out a very large correction because of the strong fundamentals that I spoke about. Uh, and on the broad-based Nifty BSC NSE, it's still 21, 22 times the market. It's not something extremely high multiple there. So I don't know whether a large correction come in, but of course a time correction if the earnings growth a little bit slips and the valuation multiple also stabilizes. So that's how I think I kind of see this market.
Right. So, Abhisar, one quick question before I come to Sandeep Bhai for his question or some input. So, Abhisar, it's always, this is, last 4 years or 3, 4 years have been too kind for everyone. So, people mostly, barring some smart investors, majority believe that the market luck, they construe this as their skills, right? Which is common until unless things go in the other direction. People believe they are the smartest people. But again, there is always, across the fund managers, it is being said, then they always talk about the expectations within the limit of, say, 14-15%. And in these markets, the expectations of majority of the participants are above that. So how we can, basically the question is, do the fund managers believe that if we will set a expectation which is above this number, we won't be able to meet those expectations continuously? Or is it like over a long period of time, the absolute return will be around those figures only? So, any comments on that?
So, Prince, the way today's market is priced, while long-term fundamentals no doubt are very good, and with the current dispensation continuing to be in the government with I think, a decently strong coalition which will last its full term. Thankfully, the reforms will keep continuing, and hence the long-term fundamentals of the Indian markets will not get shaken up. But see, I think from here, the earnings growth itself will be in that early teen to mid-teen, at least for the next 2 to 3 years. Over 5 years, 7 years, it is not so easy to forecast the earnings growth for the next 5 years, 7 years. So I think next 2 to 3 years, if the earnings growth is early teen to mid-teen, then that would be the range of return sprints. And for the near term, we may have to spend time in this range because we have been continuously going up and pricing more than the earnings growth in the last 6 months, 1 year, 2 years. So that's how I will look at it. Hence, for the near term, if market participants feel they can make 15% plus very easily, it may or may not come through. Over long term, for 5 years plus, market participants can make 15% plus from current levels of 24,000 plus Nifty. They can make, I think earnings growth over 5, 7 years can be in mid-teens, and you can make that much. But a number well above that will need a lot of more things to fire up for the country, and hence to get us to a earnings visibility of more like 18-20%. At this point of time, I don't think so. From a high base of earnings of FY24, we are seeing that the earnings CAGR can be more like 18-20%. We are seeing it more like early to mid-teens.
Right. So, Sandeep, over to you.
Hey Prince, hey Abhisar. Pleasure listening to you. Without much of pleasantries, I'll straight away ask a question. Given I was just quickly looking into your scheme, Abhisar, it looks like most likely you.
I'm not able to hear the question, Prince.
Sandeep is not audible to you.
No.
Okay.
Sandeep, can you please quickly drop again,
Yeah,
drop and
sure.
join again? Okay, brother.
Now I can hear it. Sorry.
अरे चलो कोई नहीं, एक सेकंड.
When he said the last line, I could hear.
Okay, I thought he's not audible at all. Yeah, Sandeep bhai.
Hello, am I audible, Abhisar, now?
Yes, you
Okay,
are audible
perfect.
now.
So, I mean, first of all, pleasure meeting you. And second, I'll straight away jump into a question which I wanted to ask from you. Is that looking into your AIF, it looks like you probably have 20 or less than 20 kind of stocks, and mostly in industry leaders. At least that's the material on your site says. And which I'm assuming will obviously be bottom-up kind of a style of investing. And if that is the case, then are you market cap agnostic in your approach? And if that is the case, are you able to clearly see the pattern that mid cap and small caps in general in India are much more costlier than probably a 10-year, 20-year series will suggest versus large caps? Are you able to see that dichotomy, and is it influencing your investment decision?
Yes, Sandeepji, excellent question. Thank you so much for that. So yes, first I confirm that we are a concentrated fund generally with 20-25 investments range. We are also flexi cap in nature. So we, in this selection of these 20-25 stocks, we choose investments across the market cap range, and we are market cap agnostic. And you are very right. We are currently seeing that at least at the indices level, as the SEBI and MFI defines it, which is basically mid cap being 101 to 250th stock, and small cap being the next 100 or 250 stocks from 250 onwards. Those indices are definitely trading at multiples which are much steeper than even the very, very long-term averages. And also from their peaks, intermittent peaks when they have previously kind of peaked out. Okay. At those kind of levels also right now, these indices have kind of crossed those limits. So of course, every cycle is little different, and with 10 years of good reforms and solid government in place, one can argue that the earnings visibility growth for these kind of companies over the next 10 years, 15 years is looking strong, and that's why market is willing to risk, pricing that for much longer. But generally valuations do come back into play. So your question of whether this is influencing our decision on how we play and where we play more, it is definitely influencing, at least in the near term. And hence, even in one of our funds, which had raised money in the last 6 months, we have been kind of finding more opportunities on the large cap space, and also we have not been able to kind of fully deploy that capital even being into the fund for the last 3 to 4 months. We are taking our time. That's not just to kind of say that we don't find opportunities in the market, or we are trying to bat for some fall or something, or we are trying to time the market. Not at all. We are just trying to basically kind of see more opportunities on the value of fair value disconnect for the fundamentals in, say, little larger caps, and the mid and the small caps. We have to be kind of coming to a situation where we need to be a little bit more patient in even the stocks that we like, because the valuations and assumptions look quite aggressive to me in how the market is pricing them. And that's why the supply is also hitting, Sandeepji, in I think those spaces and sectors, and now the supply is hitting the market at a much more ferocious speed than.
Any follow-up, Sandeep, or
Yes. So just a quick note on that, just to probably lighten up space a bit. So, Abhisar, thank you. I mean, obviously, we are probably same age, so please call me Sandeep unless you want me to call you Abhisarji. That's one. And typically, whenever a stock drops out of Nifty in past, people used to feel it's a bad news. And just like 6 months back, I think I'll just not take name because Prince usually avoids that. A stock was taken out of Nifty, and somehow I jokingly said, "Don't worry, it will go to the mid cap. Given the kind of flow, it will probably do much better." And you will not believe it actually did. So that has been
Yeah.
the kind of a structure of this market, where this blind assumption percolated by social media that mid cap and small cap have a fundamental right to beat large caps. And this is like a self-fulfilling prophecy also, in a way, right? If you uh, throw money into a small pond where there is not much of exit is happening except by promoters, obviously your words will come true, unlike in Nifty where there is a constant exit also by FII. So that was the point. I'll not probably take too much of a time. We'll go back into the queue. So we have few more things to discuss, but over to other speakers.
thanks, Sandeep. So, Rajat, you can quickly unmute and ask your question. Rajat, you are on mute. Okay, Madhava, you can go if Rajat is busy.
Yeah. Hi. Am I audible?
Yeah, go
Yeah,
ahead.
yeah, I can
Yeah.
hear you.
Hey, Abhisar, ji, good to hear you speak. And Prince, thank you for giving me this opportunity to speak. I have a question on the investment style considering this market conditions, right? So currently, I mean, at least me and my friends, what we were doing is that since there is a new government and this new government has a certain priority, we looked at their manifesto and then we saw that they have some priority of 4 5 sectors. For example, green energy being one, defense being one more, semiconductor being one more, and recycling one more, and some stocks from the water sector. Now, having looked at these sectors, our anticipation is that the government may give a lot of incentives to boost these sectors because they've already told in their manifestos. And how these sectors are different from other sectors is because if, let's say, I invest in a banking or pharma or something, the incremental gain probably could be lesser compared to new sectors which are emerging and has a government push over here. And also considering this is investing and not trading, probably, if we invest in some of these sectors, is it worth trying this kind of investment style for the next 3 to 5 years? I hope my question is clear.
Yeah, question is completely clear. Uh, so see, my view on this is that your thinking is in the right direction, no doubt about it, and these sectors will have a very long runway of growth ahead of them, and with obviously favorable government policy, the companies in these sectors will be better positioned. However, having said that, generally, the investing in these kind of themes would generally require a much longer period of investment as a starting point. Currently, what's happening in the market is that investing in these themes is generally giving instant gratification, right? So you invest, and even if the numbers take a lot of time to show up, or even the business model is still evolving, the stock market is kind of rewarding the companies or the stocks immediately, which is making these sectors to invest looking like more attractive than they are actually. Okay, I hope you're getting my point. So effectively, what's happening is that it's the reverse loop which is working in the mind of investors, that uh, this is something which they should have in the portfolio, and this is something which can possibly make a large CAGR if they have a well-diversified portfolio. My view is that generally, even in the new sectors that emerge, or the new themes, or the popular themes which do have the government backing, it may or may not be so easy. So while the top-down theme is correct, and you need to watch out the space, of course, in each of those themes on how they evolve and how much the policy support comes in. The right investing will still be bottoms up. And I would not mind, the initial period of high gains, being let off in some cases, and coming in little later in companies where the business model gets proven, and hence will have long runway of growth. But my only 2 cents here will be that generally the investment period in these kind of themes to make much more stable and sustainable return will be greater than 5 years. So that will be the one. But of course, some of the spaces that you talked about, there are some companies in those spaces, like say water, or even say recycling, where there you may find companies which have been around for quite some time. So hence, in those companies, if your investment strategy and filters are getting cleared, then of course, you can bank on that. But on green energy, or hydrogen, or semiconductor, it is just completely new. So it's more of currently sort of early stage VCK stage kind of stocks and companies that we have to look at. So I think it is a little bit more nuanced.
Yeah, thank you. One silly question. You mentioned top-down and bottom-up investment style, right? Can you please elaborate a little more about it?
So what I mean is that, of course, the stock selection is all bottoms up, because we, at least at our fund, we do have a very clear defined filters and a strategy in place, which each stock should satisfy and fulfill for us, for it to come in the portfolio. So that bottoms up means are studying the company, individual company within any sector on those parameters, and doing a research, possibly also doing a lot of third-party stakeholder check. The top-down is basically where we do have views like you mentioned on the themes and on the sectors. So that is the top-down view wherein effectively say I'm very positive on the overall healthcare space, or I'm very positive on the whole renewable space, and hence there we have both macros in our favor and also the industry structure, industry setup, or the capital cycle in the industry in our favor. So making a top-down view, there are five, six things which go into it. It's not just the sector doing well, but also the capital intensity and how the capital cycle in that space is, currently placed. Because I would like to tell you that, look, the sector could be very attractive and the government support could be there. But if the competition heats up beyond a point, okay, then the capital cycle may or may not be favorable, and the competition might force all the players to operate at low margins and hence low ROE, ROCs. And that then would automatically not turn into returns sustainably. There may be a pop-up initially, but hence later on the returns will all normalize and the players will start fighting among each other. So the top-down view is basically made on the sectors and the specific subsectors and the themes based on multiple factors and attributes.
So, Abhisar, this is, although you touched upon few points in continuation to that. So basically, screening criteria, like although there are some themes, we identify the themes and then look for companies. But are there any screening criteria basis that you filter and then you choose a certain basket of companies, say 100, 150, and then you further start your research? At some point in time, good companies are not available at a favorable valuation, so that goes as a part of watch list. So finally, my idea is like from the starting point at Monarch to a time wherein the company enters your portfolio, how it goes for you.
Yeah, so Prince, we have a very well-defined investment strategy and stock selection process, and I'll take you and the listeners through some of the filters that we follow, and we kind of never compromise on them. So one thing is to first of all kind of make a judgment on whether the company is a growing company or the earnings are growing for the company. How do you make that judgment? So what we say is that we don't depend overly on the P&L to decide whether it's a growing company or not. It's quite counterintuitive. Of course, P&L is needed. Without that, nothing can happen. But we say the company is a growing company only when we see the compounding happening in the cash flow statement. So the operating cash flow should be showing me a CAGR over a period of time. Single year OCF can be volatile because of working capital requirements, because of intermittent issues in the business. So we always average the OCF for any year for the last 2 years, 3 years to get a normalized number. And that normalized number should be showing a compounding. That's the first place for me to decide whether it's a growing company or not. See, P&L is like a breaking news item, okay? And it can have some, things which are non-sustainable. It can be sometimes also managed, but cash flows also can be managed, but it's much more harder. And you are able to see much more clearer things on the cash flow. Second is on the business, how it is doing in capital efficiency. So what we kind of look for is where the business is having a ROE, ROC in a certain range, say near cost of capital, slightly higher cost of capital, but incrementally now in the last few years or the next few years in future, it is improving that ROC. It means now on the 100 rupees which I invested into the business, it is going to generate more than what it was generating in the last 10 years, 15 years. So for example, if say the ROC historically is say 14%, but now when the business is putting 100 rupees, it's not generating 14, it's generating 17, 18 or 20. So we call this metric as incremental ROC. Incremental ROC, if it is improving, that which we can see from the last 3 years number, or which we can judge from the next 2 years, 3 years numbers based on our estimates. If the IROC is improving, then fundamentally business is doing something which is making him earn a higher return on capital. This happens because of various reasons. It could be because company has done some brownfield expansion which is low cost, or company has done some cost cutting, or the company has entered into a new product category which is better margin. It has found a sector where competition is less, or it has entered certain adjacent category, or its economy of scale. They've spent 10, 20 years and now they're gaining scale. So we look for the reasons also why this IROC is improving, but we look for this. So I told you about cash flow growing, the incremental ROC coming. And then the third is how it is funding its growth. So obviously market wants growth. You get the stocks priced, and the CAGR that you get in stocks is for growth. So we look for that. If growth is there in the stock, how is it funded? Hopefully, if you're making the cash flows, you will be able to fund the growth through those cash flows, and you will not have to depend on external capital, which means you don't have to do too many dilutions. You don't keep running to the equity market for raising money, or you don't need to also raise a lot of debt. So I'm not averse to debt. I don't want all my companies to be net cash, but I also want that how they're funding the growth is not a lot of debt dependent or external equity dependent. It is more generated from their internal cash flows. And post product and
Abhisar, yeah.
sorry, I in between maybe some call
You
came.
right now it's fine. Yeah.
Yeah, sure. So we also look at, of course, the business what product and sorry. So what product and services into, and is it, kind of having some sort of leadership position in those product and services? Leadership position could be by way of market share gains. Leadership position could be by way of cost leadership. It could be some brand leadership that they own. And after doing all this, Prince, it's lastly it comes to the valuations and margin of safety. So suppose some company is there which is clearing my cash flows, which is having incremental ROC, which is also able to fund its growth, on its own capital and not need too much of external capital. It has decent product services. Should I buy it at any valuation and hope that I can make a 15-20% IRR? No. So see, ultimately, business is an evolving picture, no matter how much analysis you do, and it's a very disruptive world. Right now, what is happening is that the new innovations in the last 2 decades have been coming much faster than they used to come in the previous 4, 5 decades. So in that kind of a innovative world, like right now, we have seen that how quick commerce has seeped into our life in no time, right? We all want to now order through quick commerce and get our groceries or anything in next 15 minutes. Now, this was not there only 3 years back, right? Now, what impact can it have on so many business models? I don't know. So what I'm trying to say is that no matter how good a business is, you will never be able to kind of fully forecast 10-year, 15-year, 20-year out everything around it, and innovations or new disruptions can impact its earnings. So hence you cannot pay up a price which is, which is very, very aggressive, and hence the valuation safety also needs to be in mind. So one thing which we follow very strongly is that no matter how much we like any company, we try and keep a margin of safety. We use various things. We use DCF, we use EV to cash flow multiples. We don't go just by blindly by PE or EV EBITDA. We also look at EV OCF, and then look at what the market is factoring in with respect to the growth that the company is delivering, and how strongly can we say that the durability or sustainability of this growth in that company can be. So that's our framework, Prince, which we use to do the bottoms up stock selection. Of course, in extremely euphoric times like what we are seeing in the markets, this process becomes difficult, and in many sectors you see very wild moves. But generally, the market breadth in India is improving. Newer sectors are emerging, so we are able to still find a lot of opportunities following this method.
Great. And yeah, Sandeep.
Yeah. Abhisar, just one question more on the research for your style of a setup. I'm assuming you would have buy side team inside, which might be typically focusing more on the portfolio stocks and their associated research. But for top down understanding of market trends, you might be relying to other, let's say, sell side research reports, etc. Is that understanding correct? What extra other than stock specific research you guys do to justify or understand, let's say, industry trends or even valuation trends, etc. Just trying to read through the mind of a solid fund manager like yours.
Yeah, Sandeep. So, we ourselves, from our own research team of more than 10 people, we try and build an understanding on the sectors very, very strongly and deeply. And we get, the sell side support from all the brokers who are empaneled with us. So we generally do have all the good large brokers, I'm saying, not large cap, large brokers on the street who are empaneled with us and servicing us. Um, and hence, with our interactions with them and with our reading of the sectors, we try and form that top-down view on the sectors. And Sandeep, it's a constant learning process. Plus, the new sectors are emerging thick and fast. So it's like, you know, no learning is deep enough and strong enough. You have to continuously be at it, and try and get hold of as many sectors as possible. And that is why, even when we were just 300 crore AUM around 6 months or 1 year back, we still had more than 8 people in research. We already have 10 people in research. We are expanding it further. We do have a separate institutional equity research team at Monarch, which supports us, but which is an independent team. So that's my in-house broker also. And we have outside brokers from the likes of BNK, Equirus, Ambit, Antique, everyone. So yeah, it's a mix of both what those guys are saying on the various themes and sectors and what we make of it, and our own research, and then following our bottoms up stock selection strategy, which I just spoke about.
Thanks. Actually, quite surprising for you to tell that you had 8 research people at 300 Collegium. Surely speaks volume about your style. Just a quick question on that. I mean, going back to what I was trying to say, and this is how I'm trying to make little sense out of what is happening in market. Otherwise, anybody with any history of market will struggle to explain what is happening in mid cap, small cap. Is what if we are into a permanent decade kind of a economic run in certain sectors. Obviously it can't be in all sectors, all popular themes, and let's keep valuations aside for a sec. Let's say something like renewables, defense, or hard infrastructure, something what, let's say, happened in China and may not necessarily have the same kind of a eventual capital market returns, purely because all said and done we are still a somewhat pretended democracy, unlike China, where end goals are slightly different. So, do you get that kind of a theme and take a view in a way that we shouldn't be very myopic thinking about past 10 years or 20 years kind of a run? There are always times in history, let's say in 20s in US or even 60s, 50s, 60s, baby boomer era, etc., where for a very long period of 10, 15 years, the mean reversion never happened, purely because, and then obviously it will follow with another decade of lull, but that's probably by the time we'll become old. Any top-down research, any macro research gives you that kind of confidence on the underlying earning momentum in certain sectors.
Yeah, surely. So see, definitely on the infra creation side in India, lot of effort is being made, and we are also able to see it. Okay. Only that the quality of that effort will be seen in due course, and the speed of that effort on how much execution really happens. But I think on the infra side, for a 140 crore population, there is still so much to do. And on top of that, there is an energy transition theme which is taking place not only in India, it is across the globe, right? Because of the global warming and temperatures going up, you have to create less carbon footprint, and for that you have to do the energy transition to more of renewables and reduce more of the polluting energy sources. And now suddenly, because you have new innovation coming in, which is energy guzzling, say AI or a few others, the problem is compounded that you have huge demand and you need to create. So see, my sense is that look, in this whole infra and energy transition, it looks like extremely long and durable themes, generally speaking. Having said that, Sandeep, I would still say that you can't still take things for granted, and you still need to look at the capital cycle in that specific subsector or industry. Suppose in infra, you're looking at water or you're looking at road. So you need to kind of still see that, look, it should not happen that I create a lot of roads in India in the next 10 years, but there are so many players fighting within that space that there will be no ROE made, ROC made, and everybody will still get, small piece of business. You still need to find whether you will have two, three big winners out of that also or not. Same way in renewables, if we want to create a lot of solar capacity and the modules will be supplied whether by 3 guys or 30 guys. Okay. So that I think will need to be seen, which will sort of kind of make you understand where the returns and where the profit pools will get concentrated in within these themes. From a theme perspective, I think if something dramatically doesn't go wrong, India should be having the resources and the policy support to create a long runway of growth in at least these sectors. So the whole infra space, because we are lagging on that versus the global standards by a mile, by a very big way. And on the energy transition and green side, we have made a good beginning. So from that perspective, at least in these two sectors, I can see a long runway of growth. But stock picking, surely more bottoms up uh, to be done. Not just on the theme that you buy the whole basket and will still make very strong CAGR remains to be seen.
Yes. Actually, I mean, time correction is a very popular word, especially in financial social media, platforms like Twitter. But one thing which people often miss is that time correction is possible only in a elderly segment of market. So, I mean, I'll be more precise. Typically, I've seen that time correction is more logical probable outcome in a heated market where, let's say, fundamentals are still lagging ahead of the prices in large cap and Nifty, where both side flows are there. There is some structural inflow and then some valuation driven outflows also. But in other heated segments, be it industry specific, be it smaller caps, etc., usually time correction never happens. So fragility keeps on getting built because we keep on fooling ourselves. This time is different, world is different. It can happen till one fine day for no reason. In fact, we will always try to find reasons, right? For example, a lot of people are building up saying budget की वजह से market गिर रहा है, and I'm saying what is likely to happen in budget. I mean, I understand the long term capital gains. I mean, that's the only thing, but that's not specific to a certain. I mean, that's surely not cap dependent, right? So market always finds a reason to correct the excesses, which typically happens over a larger period of time. So market history typically suggests that excesses happen slowly, but corrections happens very sharp, especially outside of large caps, etc. So time correction, while looks very fancy, uh, it rarely happens, is my experience. But anyway, over to you, Abhisar, for anything to add on this and maybe to other speakers. And one more question which you may answer. This choice of AIF, is it performance and structure driven, or is it you are getting some more flexibility than probably you'll get in an MF mandate, let's say use of derivatives or even unlisted markets, etc.?
Yeah, Sandeep. So AIF structure is design driven at our end. We don't keep open-ended funds. We don't raise money all year round or every month or every quarter. We raise money only once in 18 months and we close it. We are very clear that our investment teams and me as fund manager basically are acumen in more in trying to do justice to that money by investing it correctly rather than being on the road to raise it all the time. So that's why it is slightly different. Also, we are raising mostly money with decent long-term orientation, and hence the structure. Over time, as we grow, we may evolve the structure a little bit, but for now, it is like this. And we are largely managing money with long only mandate. We are not using any derivatives, long, short, or leverage.
Right. So Abhisar, budget, we just talked about it is another event, but it's always good to have a view around it. So any expectations from the budget, or it's another day, people will forget about budget in a day or two, or just like the long-term capital gain, which Sandeep highlight is the something which is fear-mongering at this point in time, which might be the season of some profit booking at this point in time.
Yeah, sure. So see, budget, I'll come to the capital gain part, next. But budget overall, I think, will likely to remain fiscally prudent. Thankfully, the government has already received some extra resources by way of RBI dividend and robust tax collection. So our sense is that they may maintain the fiscal path of the fiscal deficit numbers that they have already spelled out earlier, and the extra income that they have already got, that they most likely would be able to spend on supporting the income and the growth for the middle class and the lower middle class. There is a line of thought that whatever the general election results have come through, and because of the lot of talk around the K-shaped recovery and the K-shaped growth that India has been seeing, there is a need to kind of support the job creation as well as earnings and the growth in the lower end of the K. So basically, we expect that there could be some important decisions on that front. It could be favorable income tax tweaks. It could be decisions which favor higher investments in housing sector, or it could be bordering to the line of somewhere, a little bit socialist in nature without upsetting the fiscal deficit numbers. So that's on the overall side, and hence that is something which I think market may have already factored in. Of course, on that day, it will react to specific sector getting some SOPs which are either higher or lower than what market is expecting, and hence always on a budget day there is high volatility. Nifty will swing 2%, 3% either side. That always happens. That's like, I tell you or I don't tell you. You can see go in the past in 15, 20 years, you will see every budget day like that. However, one big thing which always also been coming in the last few years is whether a capital gain tax may get tweaked, and because right now markets have been very overheated, this will be some time where they can push it through, etc. I don't expect it. Of course, you never can say no for anything, but generally, I think the tweaking in the capital gain taxes may not happen. Um, uh, they might look at the overall consistency of taxation across various asset classes. How will they balance it? I'm not sure. We'll wait for that. But overall, Prince, budget likely to be directionally positive for the market. I don't think so. There'll be any big negative on the capital market side, which derates the market multiples. But this market looks like already priced in, right? From June 4, when the new government came in, we've rallied more than 10%, right? If I'm not wrong. So the same government is there, even if in a coalition, and the same government will present a good budget. That is already, I think, market has taken it in stride. So I don't see with a good budget which everyone wants, whether there'll be further large upside in the market in the next 2 weeks. That is something which I don't know. Of course, budget day can be volatility on both the upside or the downside, plus minus 2% either side. But this is what we expect.
So, Abhisar, healthcare and renewables, you just highlighted. So, within the space, healthcare in itself is a heterogeneous space with so many subsectors within. Hardly any two companies have same dynamics, and even in the renewable space. So, where you believe within these two sectors broadly, you are looking at which pockets. Of course, names are not important, but broadly, if you can highlight which areas appear to be good from valuation and growth perspective.
So yeah, Prince, healthcare is, I think, very interesting, and also something which is quite stable and which provides long-term growth levers. So there are various subsegments, as you rightly said, in healthcare now, and we and our teams have identified more than 6 to 7 subsectors within the whole pharma healthcare. This includes hospitals as one subsector. This includes diagnostic as subsector. This includes the branded generics as one subsector. Then you have the US generics. You have the CDMO, CRO players. So the two segments within that which we feel have more long-term earnings growth visibility, while you need to be careful on valuation and pick your stock again, carefully within those sub-segments, is one is hospitals, because the whole hospital services are improving dramatically in the country, and the private players here are gaining a lot of traction. They're gaining a lot of market share from smaller hospital or unorganized players in this space. And as the per capita income for the country, GDP per capita or per capita income for the country increases, uh, the uh, uh, the money left to spend on your healthcare improves, and that is a very big tailwind. I think that will keep on happening over the next 10, 15, 20 years. We are just at 23, $2,400 per GDP. As we double that number over whatever period, our spending on that space will keep increasing. So hospitals structurally we do like. There is a lot of also opportunities for the larger players to acquire the smaller hospitals at the right multiples, and grow through both organic and inorganic means. Then we also like the CRO CDMO space within the healthcare and the whole pharma space, because we believe that there are more opportunities coming for outsourcing from both the overall overseas players as well as within the country also. The pharma companies are focusing more on drug innovation and outsourcing the manufacturing part. So that segment is there, and then occasionally within the whole pharma space, you sometimes get opportunities in either API or generics or branded generics. So that is a part, but the CRO, CDM and the hospitals look much more structural. Diagnostic also is a good place, but it has seen a lot of competition coming in the last 3 years. And the point that I was making earlier in the call, that you need to see the capital cycle. At one point of time in diagnostic, it was supposedly believed that it can have a 10, 20 year of runway, but suddenly, a lot of competition came. So even extremely good and solid players saw some dent to their earnings profile and their volume profile. So that's why, of course, we are watching out for that space also for any opportunity. So that's how it is in pharma. In renewables, I think it is still evolving, Prince, to be frank with you. I think we don't have all the companies across the value chain listed in renewables. It's morely right now the one or two key equipment suppliers or generators largely in both wind and solar. But I think going forward in the next 2, 3 years, we will have more players across the value chain which will get listed, particularly in solar value chain. We may have a couple of module players get listed. We already have generators, but we will have pure solar, subsidiaries getting listed, like NTPC Green is going to get listed, or suppose only the green energy generating unit will get separated and listed. The EPC players, there are a couple of them listed, but more could come in, and then more of further equipment suppliers. So that space of whole renewables plus as the green hydrogen story unfolds, there also we would get a little bit longer and a bigger value chain. That's interesting to keep a track of. And I think value could be there in I think equipment suppliers more than even the generators. That's my initial feeling around those spaces. So we are keeping our eyes and ears open for how that whole thing evolves.
सो एक हिंदी में क्वेश्चन है, गुमनामी बाबा के नाम से हैंडल इज आस्किंग, अभिसार आप कैसे तय करते हैं कि आपको किसी कंपनी या सेक्टर में ओवरवेट जाना है या अंडरवेट जाना है?
So overweight and underweight हम तय करते हैं both by way of our own top-down view on that sector, the valuations for that whole sector, and also in terms of how many good investable opportunities are we able to find in that specific sector based on our investment strategy. So like, say suppose today I just said that we are looking like to be having a overweight position on one subsector within pharma. Okay, so that is based on both my long-term view on that space as well as the kind of opportunities that I see based on the valuation which are prevailing. Same way in BFSI, which has been overall doing well, but the valuations are quite attractive. I would tend to have, an inclination wherein I would be much more comfortable and happier with an overweight position. So it is to do with both the view on that space on top-down basis and also the valuation. If view is
And
very good,
Abhisar,
but the valuation is extremely high, I may or may not have overweight, right?
so two important questions, Abhisar. One is like I would happy to hear you talk about your mistakes of the past, and secondly, selling is an subtle art wherein majority of the market participants struggle, right? So what is the sell framework you use at Monarch, and the mistakes which you had done? Obviously, everybody has plenty of mistakes, but few you want to highlight.
Yeah, sure. So Prince, actually, on the mistakes front, I can tell you that we wrote one newsletter in last year in July 2023, where we kind of laid out our investing framework as I just spoke. It is there on my Twitter timeline also. You will see in that investing newsletter, we made it a point to put down both the top five highest return generating stocks for our fund and the top five losers of our fund. And those were the mistakes where we kind of lost money. In the top five losers, we would have lost between say 20 to 50% of our money in say 3 or 4 of those stocks. And the mistakes happen, because of variety of factors. It is largely because of little bit of an overestimation on the earnings trajectory and the prospects for the company. Sometimes it is also due to the assessment which is very aggressive in nature of what that industry can grow into or what the profit pool can be. So the mistakes that we have happened in the last 1 or 2 years have been one or two names on the chemical side. One name was on the retail apparel side as such. So I think, see, it is very difficult to completely avoid the mistakes. However, what we kind of focus on in is that a term which I have learned from Mr. Michael Mauboussin's paper, which is slugging ratio, which means that what it says is that when you go right, how much money you make versus when you go wrong, how much money you lose. So that ratio is called as the slugging ratio. So over time, to have a successful kind of a, investing journey, generally you should end up having a good slugging, high-end slugging ratio, wherein Suppose you're making money in 8 companies, you're making quite a good number. And when you're losing, you're not losing beyond a point. You're able to identify that you have done something wrong or your thesis not playing out, and you're able to cut in time. So that is something which we are working very hard on to kind of improve. That doesn't mean we start doing extra churn, and anything which falls 10-20%, we immediately put a stop loss trigger or something. In fact, when the thesis is right and the stock falls, we are very happy to, because we can buy more at cheaper prices. But when really the thesis goes wrong is something where the mistakes happen. So and that has happened with us. Every year some of the other mistakes have happened in the last 4 years of my investing journey in the Monarch AIF. Coming to the sell framework, see, Prince, this is tough. Sell decisions are tough, and it is also influenced by the setup that you are operating in. Because see, we generally tend to kind of think about selling as a exercise which will have a straightforward answer. Okay, that buy with these methods and sell with this method. It is not with uh, that kind of simple structure. It depends on what kind of overall setup that you're operating. For example, MFs today can churn more, right? Because they are not taxed at their end. It's the investor. If he holds a MF more than 1 year, he will be in long-term capital gain. If he sells within, he'll be short-term. MF, on the other hand, can try and generate an absolute return for investor by doing either very large and fast churning, like some of the MFs are doing also, which are currently topping the charts, or they can also generate returns by holding for very long. So see, actually, it depends on the setup to some extent. However, for our case, okay, coming to what I do, our funds are more closed-ended. They are long-term oriented. Generally, we have a term of 5+2 or 4+2. So we end up owning every stock in a way that we are good and confident enough for the next 2 years, 3 years, 5 years of earning, and we are also like the business model long-term basis. So we come in with the assumption that we won't kind of sell in a hurry. However, when we sell it's on two things. One is that the original thesis has seen some material change, or our assessment was much more aggressive than the reality, or some new information has come in for the industry, which is changing the whole setup. It could be a regulatory action, or it could be extremely high level of competition coming in a quick time, like it has happened, say, now in the paint industry. I never own paint stocks, but I'm just telling you. So that then can change your assessment of the original thesis, and hence that time is the best time to sell, because you can then run into both the earnings derating as well as the valuation derating kind of a structure. Second is a much more difficult way of deciding to sell, which is basically when the valuations go to extremely, extremely high level. Now, this is very difficult because the valuation can continue to stretch and you may end up selling early. But generally, see, we try and look at on the valuation side, if a lot of optionalities are already priced in, next 5 years of solid growth is already factored in. Whatever was our assessment, the stock has crossed those assessments in a big, big way, and it is priced more than perfection. So sometimes on valuation also, we tend to kind of sell and go into something else which is giving us much more margin of safety. But the second point of sell decision is done with much more careful nature, and it is done less frequently. The first one, wherein the thesis gets changed, or my assessment was aggressive, my analysis was not that perfect. Those things when happen, we kind of have made it a point to accept it, and not be emotionally attached to the company, or not be biased, or not being. You have to be humble enough to accept that you went wrong there. So that's, I think, something which we are trying to get better at. I can't say We are extremely good at it right now, but I'm trying to kind of improve on that process every quarter and every year to see where the original thesis got fractured, it got damaged, and you need to accept and move on.
So, Abhisar, one last question from my side, and then Sandeep, and other speakers for their questions if there are any. So, what are the key lessons that you have learned over your investing career that have shaped your approach the most?
Sure. So I think Prince, see now I am, into this field for last 16 years, first 10 years being on the sell side where I was researching and maybe putting out reports and recommending other institutional investors. And now last 5.5 years, 6 years on the investing side where I have to invest my money and my investors' hard-earned money. So I think two things, two learnings which till now have shaped my thinking, my approach is first that uh, one needs to think independently and deeply. Okay. What I have seen is that the deep thinking brings better perspective to my analysis of business, and it let me visualize a little bit more long term and the range of outcomes and quality of business. See, and for doing this deeper thinking, it will require me to read more. So there is no downside to reading, right? The more you read, the more wiser only you can become. Sometimes you will end up reading a lot of stuff which you may or may not have needed, but it will only help you somewhere. So I think what I try and do is that I try and think independently and little deeply on each of the space and the topics and the companies that we are looking to invest in. And for that, try and do as much reading as possible. I think that will be my advice to even every investor that they can try to read a lot and then think little deeply and independently by cutting the noise. Secondly, is I think what my assessment and study of many successful fund managers till now is showing me is that over long term, see, short term can be anything, but over long term, one thing which makes certain fund managers and investors stand out is a strong psychological balance. So there are a lot of studies out there which have shown that over longer tenures, say 10-year plus, the alpha is driven more by out behaving. It's 70% driven by out behaving, and only 35% is driven by out analyzing or out knowing information before others. Okay. So so I think this is the second thing which has shaped my career, that we need to be very strong psychologically. We need to have a very strong psychological balance in investing. It's important to understand that it's not the noise which is very important, but the poise and the strong guts to do the right thing at majority of times. So because because you may be get sucked into doing things which are much more riskier or which are outside of your strength or your domain in the market from time to time. But if you're psychologically strong, you will be able to tweak your strategy a little bit, but you will not be doing things which the market is forcing you to do. You will be effectively kind of balancing your own strategy and your own strengths with the evolution of the market. So that's the two learnings from my side, Prince, which I would like to share.
Great, Abhisar. So, Sandeep,
Yeah, Prince, I would like to take a question, which is actually, I think, towards Abhisar, but he'll probably not get the complete context. So, Rajesh G is asking, AI formation is primarily for AIF and Anchor. So, Rajesh G, on a light note, that's you are coming from a very narrow market frame, which is SME microcap. I mean, I'm sure Abhishar is aware, and maybe a good chance he's not even aware. Not everyone is there. Just to give you a context of Rajesh, microcap is roughly 1.5 lakh, 1 lakh kind of a market cap right now. and India will be what, 3.5 trillion, so easily 30 plus. So we are talking about 2% of market cap, which in any case is euphoric. So any fundamental or PAT perspective, the micro caps will be less than 1%. I'm talking about the listed one. I'm not talking about the MSME segment of economy per se. I'm talking about the listed universe. So within that, you are saying your question is coming from that reference. They are in general 600, 700 AIFs, and everyone has a different mandate. So we surely need to learn a bit more, everyone together, you and I and everyone, to understand that AIF mandate is just not for anchors or those special allocations. So, Abhisar, this question is coming from there is. I'm sure you might have heard about SME and all that, right? So, a
Yes.
lot of us are very active, and what is happening is that's the beauty of a bull market, right? Everyone thinks others' job is easy. So, lead merchant bankers are opening up AIFs. AIF guys are taking license of LMs. Retail want to become UHNI. UHNI wants to become institution. So
Sure.
that's clear cut sign of what is happening, right? So a lot of AIFs are currently in works with, let's say, as small capital as possible, which is 20 crore category 3 right now, with the sole intent of trying to get somehow in anchor quota, because underlying assumption is, which is obviously questionable, is that this bull market in micro caps SME will continue, and some of these schemes will probably benefit from it. So question was from that reference. In fact, on that note, Abhisar, allow me to expand it with a curveball question. What is the lowest market cap you have invested so far? I'm sure like at some stage you'll just become uncomfortable as in category or mandate. And I'm specifically asking because as when we say market cap agnostic, we essentially say that eventually fundamentals, earning trajectory, etc. matters. But if you come too low into the market cap hierarchy, non-fundamental angles like people dependency, some of these companies are not very process oriented. So that kind of a VCP style of a hand holding comes into the picture.
Yeah.
So, how much you have gone in recent past or in past, and was that experience any different from typically other listed players where your framework will be primarily cap agnostic in a way? But in this smaller cap, usually that you need nuances to handle these companies, frankly, in a way.
Yeah, Sandeep. So, I think the smallest market cap that we have invested across our all the three funds is has been around 1,000 odd crore, but maybe between 800 to 1,000 crore. But that has been very, very few occasions. It would be only one odd company or max two companies out of my 20 companies. Generally, we are finding in our kind of long only closed-ended setup where we don't get daily inflows or we never raise, in fact, in the same scheme any more money once we close it, right? So we generally are getting a lot of opportunities in that 5 to 40,000 crore market cap band. Other than my large cap positions, which will be in certain sectors, depending on the time and the period I am in. But this 5 to 40,000 crore are somewhere, companies with decently long history, more than 10, 20, 30 years of history where I can go into, lot of data. I can see how across the cycles they have performed, how their positioning is. I can run all my filters. So most of my stocks come from there. Even sometimes at, below 5,000 crore market cap or say even 1,000 crore market cap, you may have one odd company which is into the business for last 1.5, 2 decades. Okay. And it is say either still small in size or it is decent size, but not as euphorically or rightly priced. And where there is say a gap between the fair value and the current stock price, and that's where we look at. But we are not going in this market cap range a lot, as well as in terms of what all euphoria may be happening in the SME side, and many IFs just coming for those allocations. Of course, that is extremely dangerous and also very, 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 very different whole thing which is happening in the market.
Okay, thanks.
So, Shivam, Liaquat, and Sumit, in that order, you can quickly ask a question, and I think then we'll be closing.
Hi, Prince sir. Happy Guru Purnima. Sir, आई नो आप स्टॉक स्पेसिफिक बात नहीं करते हैं, पर सर मैं 30 सेकंड्स लूंगा आपसे स्टॉक स्पेसिफिक बात करते हुए, आपको अपनी जर्नी बताते हुए, और मेरे को आपसे हेल्प चाहिए सर। सर कोविड से अप्रोक्सीमेटली साल भर पहले मेरी इन्वेस्टमेंट जर्नी स्टार्ट हुई थी। मेरे फादर ने मुझे HDFC बैंक के फिजिकल शेयर्स दिखाए कि बेटा ये मैंने 40,000 रुपए में खरीदे थे, एंड जब उसको सर डीमेटलाइज कराया तो उसकी वैल्यू थी 8 लाख रुपए। तो मैंने जब पूछा तो मुझे एक किसी बैंक के ही बंदे ने अपने एडवाइस किया कि सर देख लो DHFL ठीक करेक्ट हो गया है, येस बैंक करेक्ट हो गया है, और एक किसी ने बोला HEG। तो उसके बाद आपको तीनों की कहानी पता ही है सर, मैंने टॉप में खरीदे थे, तो मेरी जर्नी वहां समाप्त हो गई। एंड देन आई थॉट कि स्टॉक मार्केट मेरे लिए है ही नहीं। उसके बाद कोविड भी आ गया। अभी सर मैंने आज से 1.5 साल पहले करीब 15 से 16 लाख रुपए ये सोचते हुए कि मैं फंडामेंटल अच्छी कंपनीज में पैसा डालूंगा, मैंने HDFC बैंक, एशियन पेंट्स, नवीन फ्लोरिन, गुजरात फ्लोरोकेमिकल्स, इस टाइप की कंपनीज में पैसा डाला, और उसी टाइप पे मेरे फ्रेंड्स ने भी पैसा डाला। मुझे आज के रेट में करीब 20 से 25% का रिटर्न है। उनको 100% RVNL, HAL, मसगांव, ये सब में उन्होंने पैसा डाला, सुजलॉन, और काफी अच्छा प्रॉफिट है। अभी एक वो भी होता है कि मैंने डिसाइड किया था कि मैं किसी भी गलत कंपनी में नहीं डालूंगा। तो आपकी मेरे जैसे इन्वेस्टर्स के लिए आने वाले टाइम में क्या सर राय रहेगी कि कैसे अभी यहाँ से बुक करना चाहिए या कैसे सेलेक्ट करना चाहिए सर स्टॉक्स?
Abhisar and Sandeep, I request both of you to take this question because ये बहुत majority of our audience है, चूंकि ये stock specific जैसा नहीं है, जो basic essence है question की वो अलग है,
करेक्ट
और
करेक्ट
इसको address करना बहुत जरूरी है। तो I request you both to share your thoughts on it.
Okay, Prince, let me try first and then quickly Sandeep can also take a shot at it. See, मेरा मानना ये है कि investors who are starting like the speaker said, Shivam, right? He said कि उनको कोविड के पहले समझो मार्केट का ज्यादा आइडिया नहीं था, फिर फादर के थ्रू एक पैसा मिला और अभी उन्होंने 2 साल पहले वापस स्टार्ट किया। तो जब इन्वेस्टर उस स्टेज से स्टार्ट कर रहा है वेयर ही नीड्स लॉट ऑफ लर्निंग इन द मार्केट, वेयर ही नीड्स टू गो थ्रू सम काइंड ऑफ एक्सपीरियंसेस, मेरा मानना यह है कि वो पूरे का पूरा डायरेक्ट खुद स्टॉक्स में स्टार्ट करने की बजाय कुछ हद तक वो पोर्शन वो फंड्स के थ्रू स्टार्ट करे। अब वो म्यूचुअल फंड्स हो सकती हैं, उसके अंदर डिफरेंट टाइप की फंड्स हो सकती हैं दैट ही कैन figure out for himself through his resources and through his circle, so that he can then see कि वो फंड कैसे इन्वेस्ट करती है। उनके आजकल सब पोर्टफोलियोज अवेलेबल होते हैं, खासकर म्यूचुअल फंड के मंथली पोर्टफोलियोज अवेलेबल होते हैं। हाउ दे इन्वेस्ट, हाउ दे जनरेट मनी, when they start on their own so early, they can have all these different kind of experiences. Like he said कि उन्होंने सारा अच्छे नामों में डाला, बट उनकी क्योंकि वैल्यूएशंस बहुत हाई थी, ओके, इसलिए उनका कैगर कम बना है, उनका रिटर्न कम बना है, और उन्हें लगा होगा या जो भी एक बीच में 3 साल पहले यही था कि वो सारी अच्छी कंपनीज तो 20-25% कैगर देती ही रहती हैं। एशियन पेंट्स विल गिव 25% कैगर एट एवरी लेवल, विच डजंट हैपन बिकॉज अब उस सेक्टर में अगर कंपटीशन आ गया, उसका अर्निंग्स ही ग्रोथ होना कम हो गया, तो इट कैन नॉट गिव दैट कैगर एंड इट वाज ऑलरेडी एट अ वेरी हाई पीक। सेम वे अभी उनके फ्रेंड्स ने थोड़े रिस्कियर स्टॉक्स में डाला, विच इज गॉन यूफोरिक इन दिस काइंड ऑफ मार्केट, बट दिस कैन नॉट बी गोइंग ऑन फॉर एवर। सो सी, इसका क्या है कि कोई एक वेरी इजी और करेक्ट आंसर नहीं है। एट एनी गिवन शॉर्ट टर्म पीरियड ऑफ 1 year 2 year, these outcomes can be anything. It's like a toss of a coin. Those guys who took more risk in investing into certain other stocks, they may have lost also 50%, Shivam. Whereas you would have never lost, big money in the stocks, the kind of stocks that you invested in. But of course, right now you're sitting on lower gain and they are sitting on higher gain. So it needs to be that balance. And then जब आपको धीरे धीरे समझ आने लगे, आप स्टॉक्स जो खरीद रहे हो वो आप खुद भी जाके समझ सको कि क्या प्राइस है, कैसी अर्निंग्स है, then you go more on your own investing, is what I feel, Prince, is the answer to this question.
सर सॉरी, मैं अगर एक काउंटर क्वेश्चन करूं तो आपसे सर पैसे का कोई ऐसा मतलब कोई ऐसा प्रॉब्लम नहीं है कि जो खोया या जहां इन्वेस्ट किया कोई फोमो भी नहीं है सर। मतलब सर कंपनीज कैसे सेलेक्ट करनी चाहिए कि एचएल था, मजगांव था, तो क्या मतलब सर रियली मतलब मेरे को लगता था सर कि हम राफेल इंपोर्ट कर रहे हैं और हम डिफेंस की बात कर रहे हैं कि हम एक्सपोर्ट करेंगे। मतलब जो अच्छी चीज है वो इंपोर्ट कर रहे हैं और हम बना क्या रहे हैं मुझे क्लैरिटी नहीं थी, इसलिए सर मैंने इन्वेस्ट किया ही नहीं एचएल में, मजगांव में, या जो भी डिफेंस कंपनीज है। तो आने वाले टाइम में जब भी करेक्शन आए तो हमको मतलब कंपनीज या जो भी स्टॉक्स हैं कैसे सेलेक्ट करने चाहिए सर? मतलब उसका क्राइटेरिया क्या या कुछ एक वो होना चाहिए?
So Shivam, see this all you know comes gradually. Okay, there is no you know straightforward formula which you can apply to all kinds of sector and all kind of companies, and hence it will come to you slowly after listening to many people and their way of picking stocks and their strategy. देखो सबकी stock selection strategies भी थोड़ी थोड़ी अलग होती हैं. जैसा आपने अगर ये पूरा डिस्कशन सुना होगा तो you would have seen कि there is a top down view, आपको कुछ सेक्टर्स जो हैं लॉन्ग टर्म के लिए अच्छे लगेंगे एंड देन आपके कुछ बॉटम्स ऑफ फिल्टर रहेंगे जिस पे ये आएगा. बट माई पॉइंट इज कि अगर आप वो शॉर्टकट लेने का कोशिश करोगे टू फिगर दैट आउट वेरी वेरी क्विकली, देन यू मे एबल टू फिगर इट आउट. आई एम नॉट सेइंग कि ये कुछ इम्पॉसिबल है, ये सब आप फिगर कर सकते हो कि ठीक है मैं इस बेसिस पे लूंगा, बट that may or may not work out as per your expectation immediately. So that whole stock selection process is a nuanced process. It's a complicated process. It's not something very simple. Also, even after you figure out and you have bought the stocks, you need to be very strong to your thesis and psychologically balanced. So that way, it basically kind of tests you and kind of does what it does. So yeah, I think that is how it is.
सर लास्ट क्वेश्चन, सर आप मार्केट में अभी कुछ करेक्शन देख रहे हैं सर 3 से 6 महीने में? और अगर आप देख रहे हैं तो सर क्या इन्हीं करेक्टेड स्टॉक्स में, क्योंकि मैंने जब भी एचएल देखा मेरे फ्रेंड को मैंने बोला कि भाई अभी रुक जा अभी रुक जा, पर सर वो मतलब 2000 से 5000 तक गया। तो क्या, और हमेशा करेक्शन में वो 10% गिरा और सबसे पहले बढ़ने वाले वही थे। तो अगर करेक्शन मार्केट में आता है
शिवम
जी।
शिवम 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 एक जो आपका पर्टिनेंट क्वेश्चन था उसको एड्रेस करेंगे. इसमें आप फिर स्टॉक स्पेसिफिक जा रहे हो कि जिसके राइट आंसर शायद आपको नहीं मिलेंगे, तो वो ही राउंड अबाउट आंसर लेके कोई फायदा नहीं होगा. और इनिशियली हमने करेक्शन के पॉइंट ऑफ व्यू में अभिसार से ही बात की है, तो आप थोड़ा अगर बाद में ज्वाइन किए तो रिकॉर्डिंग आप सुन सकते हैं.
राइट सर।
मीनवाइल संदीप भाई, यू वांट टू क्विकली ऐड ऑन हिज फर्स्ट क्वेश्चन इफ एनीथिंग?
No, 95% answer will remain same. So only thing is answer style may be different or some anecdotes here and there. मैं क्विक थोड़ा फास्ट लैंग्वेज में बोल देता हूँ क्योंकि ये क्वेश्चन मुझे भी अपने सर्कल में बहुत मिलता है, स्पेशली यंग कजिन्स फ्रेंड्स, सॉरी फ्रेंड्स के कजिन्स एंड इस तरह के सर्कल से लोग आते हैं और आपसे समझने की कोशिश करते हैं. तो पहली बात, मेरी जर्नी खुद इतनी मीडियोकर रही है कि आई फील मोर एक्सपीरियंस देन अभिसार प्रॉब्ली टू आंसर दिस क्वेश्चन. शिवम, फर्स्ट ऑफ ऑल डायरेक्ट इक्विटी से आपको जो एक्सपोजर मिलता है वो इनडायरेक्ट से नहीं मिल सकता है. तो पहले प्राइमरी एम आपको डिसाइड करना है कि आप करना क्या चाहते हो. आर यू ट्राइंग टू मेक मनी, आर यू ट्राइंग टू लर्न द क्राफ्ट? इफ यू आर ट्राइंग टू मेक मनी, स्टिल for vast majority of people on this planet, which is let's say 99.999% of the people on this planet, you should do it via प्रोफेशनल मैनेजर्स. अब उसके अंदर आप डिसाइड कर सकते हो कि कितना एफडी करना है, कितना म्यूचुअल फंड करना है, कितना लार्ज कैप. दैट्स योर रिस्क एलोकेशन स्ट्रेटजी. नंबर 2, जब तक आप ये कंपेयर करते रहोगे विदाउट एडजस्टिंग फॉर रिस्क, जिसके लिए आपको थोड़ा सा बेसिक नॉलेज एक्सपीरियंस चाहिए, राइट? क्योंकि अभी आप दो फंडामेंटली टू डिफरेंट पोर्टफोलियो को मेजर कर रहे हो. आप लिटरली कह रहे हो कि मैं साइकिल से चला लेकिन मैं तो केवल 5 किलोमीटर पहुंचा, और दूसरा बंदा फास्ट ट्रेन से गया बट उसकी फास्ट ट्रेन की चॉइस अलग थी. ठीक है, मतलब आपने चॉइसेस ही स्टार्टिंग में अलग ली है, तो ऑब्वियसली आउटकम अलग होगा. और वो आउटकम जैसे कि अभिसार कह रहे थे कि वो ऑब्वियसली बिल्कुल डिफरेंट हो सकता था. तो जब तक आप अपने स्टॉक सिलेक्शन को रिस्क एडजस्टेड फ्रेमवर्क पे इवेलुएट नहीं करोगे, आप जो स्टॉक्स अपने वर्सेस फ्रेंड्स के बोल रहे, तो फंडामेंटली टोटली डिफरेंट स्टॉक हैं. And if I mean, I'm no big investor, but I have never touched HCL and Massgaon. आपको तो पता नहीं रहा होगा, मुझे पूरी स्टोरी पता है कि क्यों हो रहा है या क्या लॉजिक है. उसके बाद आई नेवर डेयर टू बाय अ सिंगल स्टॉक. Not that it will help you, because my style is different. I am chasing different, and incidentally I might have got the same kind of returns which you are talking from your set of friends, because I did something else. थर्ड थिंग इज कि जो फ्रेंड के कितना पैसा बन गया, इसका कितना पैसा बन गया, तो मैं हमेशा बोलता हूँ, अब तो मुझे वो रट गया है तकिया कलाम जैसा, कि जब भी आपको इतना दुख हो ना कि अरे मेरा केवल 25% बने और किसी के 100, तो सीधे मुकेश अंबानी पे फोकस करिए ना, फ्रेंड पे क्यों फोकस करना है, और भी बढ़िया सा दुख होगा. तो इसलिए इसलिए आप लर्निंग के पर्सपेक्टिव से आ रहे हैं तो आप बिल्कुल राइट ट्रैक पे हो. ठीक है, अगर आपका प्राइमरी मनी है तो आप प्रोफेशनल मैनेजमेंट लीजिए, मैं मिक्स एंड मैच कर दूंगा. क्यों? अगर आप फुल टाइम नहीं भी इन्वेस्टर बनना चाहते हो, तो अगर आपने अपना 25% पोर्टफोलियो डायरेक्ट इक्विटी रखा है, तो लर्निंग आपकी जो आती है दैट अलाउज यू टू इवेलुएट दोस प्रोफेशनल मैनेजर्स. सो अगर आपने 75% पैसा अपना म्यूचुअल फंड या डिफरेंट इंस्ट्रूमेंट्स के थ्रू डाल रखा है, तो भी वो म्यूचुअल फंड में कैसे मैं सिलेक्ट करूं ओवर माई लॉन्गर पीरियड ऑफ टाइम, लेट्स से ऑफ 10 years, 20 years, 30 years, कैसे एसेट साइकिल्स पकड़ूं, कैसे एसेट एलोकेशन डिसाइड करूं, मार्केट साइकिल समझूं, इसको समझने के लिए थोड़ा साइड में डायरेक्ट इक्विटी से आपकी एबिलिटी टू फाइंड प्रोफेशनल मैनेजर्स बिकम्स बेटर. सो फ्रॉम दैट पर्सपेक्टिव आई शुडली रिकमेंड डायरेक्ट इक्विटी. बट शुड इट बी 100 or should it be 20 or 15? Obviously anybody's guess, but it should be a function of what you want to do at the age of 40, right? अभी सबसे ज्यादा मुझे जो दुख होता है कि 20s में सब लोग बैठ के इन्वेस्टिंग कर रहे हैं, तो इंडिया में काम कौन करेगा? And this is the time to have beers and pranks and roaming around, unless you have already made up your mind, Shivam, that कि मुझे इस फील्ड में ही काम करना है. जैसे बार बार लोग बोलते हैं, आप डॉक्टर के पास ये नहीं कहते हो ना कि गूगल से मुझे एक बार दिखा दो, उसके बाद मैं खुद से ऑपरेशन किया करूंगा अपना, राइट? तो आप लोग फाइनेंस में जस्ट बिकॉज यहाँ पे डोपामीन मिलती है, सबको ये क्यों इच है कि मुझे खुद से सारा करना है. ठीक है, so that's the only thing I would like to add. Beyond that, whatever Abhisar said, I fully agree. And one last thing, one in fact tactical advice I will say, the names which you suggested, in fact I am also a bit guilty of missing some of those switches. I mean HDFC Kotak is a big holding for me. I trimmed down a little bit. I will add them because those were, for me, those were my FD stocks कि मुझे 10% 12% की एक्सपेक्टेशन वाला मनी चाहिए, बिकॉज आई एम 100% इक्विटी फॉर लास्ट मे बी 15 years. तो वो वाला सेगमेंट ऑफ पोर्टफोलियो, बट आई कुड हैव बीन मच स्मार्टर देयर आल्सो. So the only thing which I will add here, Shivam, is even if you have decided risk appetite, because it looks like from your first experience, you next time went into search of quality, right? And because markets have been kind, you still made decent money, and those were fantastic selections. But those selections were from a rear view perspective. So even in that segment, you can just keep on reading. And the beauty of that segment is, unlike other segment, HL मैसगांव की आपको कोई बढ़िया क्वालिटी की रिसर्च ही नहीं मिलेगी, आपको बस मिलेगा फोमो. इसने बोला, उसने बोला, इसने व्हाट्सएप पे बोला, उसने टेलीग्राम में बोला, राइट? लेकिन आपको एचडीएफसी में कम से कम नेट पे 20 अलग अलग रिपोर्ट सेल साइड की कुछ दिन में आ ही जाती है. आप गूगल करोगे तो बहुत सारे इंटरव्यू मिल जाएंगे. एंड देन यू ट्राई टू रीड what people are saying, what is happening. These are quarterly results companies, long history. तो आपकी जो लर्निंग होगी वो बहुत अलग लेवल की होगी. तो more than just putting money, try to create a thesis one pager if intent is to learn, right? उस लर्निंग से जब आएगा तो जो आपका नेक्स्ट साइकिल होगा 5 years के बाद, उसमें आप बहुत स्ट्रॉन्ग इन्वेस्टर बन के जाओगे. Assuming you want to become an investor, I'm still not sure whether you want to be. If your primary aim is money, then you can surely take a different path.
थैंक यू वेरी मच संदीप सर. पर्पस खाली लर्न करने का है, पैसा कमाएंगे बट ऐसा कुछ नहीं है कि यहीं से कमाना है, यहीं से खाना है. पर सर आई गॉट माई ऑल आंसर्स. थैंक यू सो मच सर.
I'm saying money making is not a wrong goal per se. Please don't get me wrong, right? I don't think my younger brother or my elder brother should. I mean, they don't even care for financial markets, right? They're only investing because money should grow, right? So in itself, it is not a bad goal. So don't. I mean, it's very fancy to say I'm here for learning. I mean, I'm personally not here for learning. I'm here to make money, frankly, right? Learning जितना करना था कर लिया 20 years. तो I'm just saying, आप हाँ, अगर आप लॉन्ग टर्म खुद ही डायरेक्ट इन्वेस्टिंग करना चाहते हैं तो यस, इट इज अ वेरी गुड अप्रोच. डोंट कंपेयर विथ अदर्स, दैट्स ऑल आई विल से.
Right. So Liaquat, you can ask your question to
Hi,
Abhisar.
friends. Thanks for this opportunity. I have one general question and I have one sector specific question. The general question, it's a bit off the topic, but I'm not getting the information from anyone. So I thought, I'll take this question here. I'm in market for last 6 years. Last 4 years, I'm investing. I'm a mechanical engineer by background. I'm an inspection engineer working with Saudi Aramco. The thing is that I've started investing more after the COVID, and by God's grace, it's going well, and alhamdulillah, there are profits. And last 2 years, I'm paying surcharge, including this year. So I was thinking, like, when
I think we lost you, Liaquat. Abhisar, are you
Yeah,
able to hear
we
him?
lost him. Yeah.
scale it to a company or investment company or something. I would like to know from the experienced guys over here, when we need to think about an investment firm, or we keep on going as an individual investor. Is there any implications? Because we have 10 more days to pay the tax. I'm here to make the money because I'm of course, I think most of us are here to make the money, and we learn, and the output of learning, it translates to money. That's what I believe. So my question, when we need to change from an individual investor to an investment company or something, or which is preferable? I'm a bit confused here. If anyone can guide me, yeah.
So you got the question, Abhisar?
Yeah, Prince, if I got it right, it's more around optimizing taxes on the gains of the investments. So, so I think, Prince, it is more left to the tax experts per se. Sandeep may have some view on it, but my sense is that individual level, whatever we pay short-term and long-term capital gains, that is the bare minimum on equities that you will kind of have in any sort of structure or setup that you end up doing. Uh, I don't think so. There can be, of course, investors try and optimize within those two buckets of short-term and long-term capital gains, in certain manner based on their own kind of trading history in any particular year. But creation of the investment firms and others, I think Liaquat would need to kind of sit with more of tax consultants and do his findings to kind of figure it out on a correct basis. Sandeep, you have any other view?
Sorry, I completely missed the question. If Prince or anyone, otherwise we can skip it also.
So Sandeep basically is asking from tech standpoint, in the sense like when one should move from an individual investor to some institution, if I remember correctly.
Forming an investment firm of his own to save on
Oh,
taxes.
uh, I mean, tax usually should be the last criteria. That's my experience, because we often miss that. I mean, your planning should be on net tax adjusted basis, but often what happens is in a 1 year bull run, 2 year bull run, we suddenly try to jump into, let's say, certain structure which we cannot handle as an individual. So like obviously I don't know enough about you, so I can't give you a specific answer. But personally, a lot of people who can easily do an AIF, etc., are registering purely because they don't have mental uh, bandwidth or compliance expertise, or basically the entire expertise plus bandwidth to do that. So just for few percentage point extra, one shouldn't be jumping on a structure. That's my general advice. Obviously, for a specific, without knowing your portfolio construct, your net worth, your goals versus options A versus B, it is very tough question to answer.
Right. So Sumit is next in line. Sumit, you
Yeah,
can
hi.
quickly.
Yeah, thanks. Yeah, Prince. Thank you. Thank you, Prince, for giving me the opportunity. Yeah, my question to Mr. Abhishar. So, Abhishar, I want to know, like, as the topic says, the euphoric market. So, as a fund manager, like, what is the framework you use to, to identify or to say that we are into a euphoric market? Like we keep on hearing like India is on a growth story and there is more needs to come. But like, do you follow any framework on that basis you decide that we are in a euphoric market? And yeah, I just wanted to know your views on as a fund house manager, how do you perceive it? And as a retail investor, how we should take this euphoric market. And when I'm saying this as a retail investor, I want to know basically like yeah, once we get into the euphoric market, how a retail investor should behave, like behaviorically, and in terms of what should be the investing style there. Like I keep on hearing, or in fact, I know few people in this circle. They time it pretty well. When I say time it pretty well, like I have seen people around the March cycle, and whenever there is some fall and all, they were in the in some cash. So like, what would be your opinion, or what would be your advice to for a retail investor to behave into such a euphoric market? Yeah, that's my question.
Yeah, Sumit, good question on how to kind of take the temperature check on deciding whether it's euphoric market or not. Of course, it is one's own assessment. It might be euphoric in my assessment, or somebody else might be thinking that it is really, very attractive market, or there is a lot of value everywhere. So it is little subjective, but I'll tell you on what basis we kind of think over it and we decide over it. And you can never get this question precisely right or the timing precisely right. Neither the objective is to get precisely the timing right, because it is not doable. It is not doable to know exactly on which day, which month the markets can fall big or can further rally big. See, but euphoric market, how we kind of look at it is from multiple lens. And one, of course, is that how much have been the past 3 year, 5 year CAGR returns of the market versus the earnings CAGR of the underlying, which is basically the Nifty components. And like Sandeep earlier also mentioned about the mid cap, small cap, indices and their components. So on those metrics, the valuations have expanded, of course, with markets itself becoming 3x from COVID lows, and even pre-COVID lows, which was in Feb 2020, the market was somewhere around 11,500 on Nifty. From there also, it's more than doubled. Thankfully, the earnings have also kept pace, but still the multiples have expanded. That is one. Secondly, the euphoric markets come from the point of view of analyzing the behavior of widespread market participants and the overall flows and liquidity and everything. So all those things are also running at extremely high level of exuberance. So that doesn't mean that that is anything wrong. It is about maturing and deepening of our markets, which is in fact good for long term. But in the short run, there is widespread optimism. There is widespread, confidence that our long-term fundamentals are so good that nothing may happen to us in even short term. So while the statement is right that our long-term fundamentals are very good, but it doesn't happen that if long-term fundamentals are very good, there will not be short-term hiccups or bumps in the journey. So this is an extremely good market for somebody who will be very immune to even 20-30% falls in his portfolio on the short term. But for one who may or may not have that appetite, who is in the illusion that since it's an extremely attractive market for long term, I will have a one-way journey. For that, I am saying that one needs to be a little bit kind of cautious of the other side. Also, that you need to stay prudent. On the retail investor, look, you know, it is like that of course everybody, as Sandeep very beautifully mentioned, that you need to find your purpose in the market of exactly what you are in for, what stage of your own investing career and learning you are at, and then decide how much you want to do this on direct basis and through professionals. Generally, when the markets are very overheated and if they go through any violent adjustment or even time correction related adjustment, the retail may or may not be fully equipped to expertly handle it. You mentioned, some of the guys are able to time it. See, it can be case to case. But I would, it would be very hard to imagine that a vast majority of the investors will be able to kind of maneuver around it. And believe you me, being in this space for the last 15, 16 years, I think only one thing which is extremely tough to do is, to time the market. It's not possible at all. It's just not possible. And also having a very strong 3 months, 6 months view, that also is impossible. Nobody can know what the market will end this year on 31st December. I can tell you that much. So see, only we can kind of judge is the current overall temperature in the market, the scenario in the market, which looks to me that in many segments, it is extremely stretched. That's why in those segments, stocks have doubled in last 2 months also, and from a high valuation. That tells you a thing, right? It cannot be a very large value sitting there, which was not known from a high level and further doubled. So that is telling me the temperature in the market overall. That doesn't mean market has to fall next week or next month. That doesn't mean that this is the top, or the December end level can't be 5-10% higher than this. That's not what I'm kind of trying to say. So this is how we define it, Sumit. And I don't know exactly, you know, if you also feel that it's euphoric market, then what as retail you can do? That I can only say that you can be a little bit more critical of your whole portfolio. You can look at each of your positions much more carefully. And if you've not seen many cycles, and you've seen more up cycles than down cycles, then you can try and shift more portion of your money to professional managers and funds. You can work on asset allocation. There are asset allocation dedicated funds in mutual funds, which beautifully shifts their assets on equity overweight to equity underweight, and they hold other asset classes also, like debt, gold, and others. So that will help you, further in per se in mitigating the risk, but it has to be on your risk profile per se.
Right. So one last question. We already stretched on time. We had planned for 1 hour or 15 minutes, and it's already 2 hours. So a quick question, and then we close for today. Yeah.
Thank you, Prince. No, no, I'm there, Prince. Prince, so my question to Abhishek Jain is that I know we cannot predict the future, but with the AI, with the models, whatever we have, I want to have his opinion. What kind of indicators that he's looking into, or what, like high frequency trade indicators or other indicators, that if he can give those input. Of course, I'm working for more than the reason I'm asking this question. I'm working on the AI models basically, which predicts the future, not the like yearly or 1 year or 1 month, but but the next day candle basically, which will be open and close, which I have worked and I have got some success, but I just want to have some more inputs on that. That would help me, like his input, like as a portfolio manager, what he looks at. That's my question. We all know, like we have something like RSI, or EMAF, or you take a BB up or lower or middle. Those things are there. but what exactly he takes a look and what indicators he takes a look. Like example, I want to know is like, does they mean they look at from the perspective of volatility models? They look, or behavioral financial metrics, what they look, or sentiment analysis tools what they use, or just a brief about this, whatever he can provide the input. That would be great. Thank you.
Yeah, Amit, so see, there are certain funds who kind of invest based on the technical factors and filters that you have mentioned. So as such, both my background is completely on the fundamental research side of investing, and hence we don't mix technicals with this, leave alone technicals on and very, very short-term basis. But of course, there are many funds and many strategies now which work on a lot of those parameters, where I think you will get some inputs from the right people who kind of run those funds, or the technical guys. Currently on the AI side, whatever tools we are using is not to second guess the stock price movements, which are also a proper, credible method, and this may evolve. Like you were saying, you were also working on it. So we are not discounting any techniques or AI's ability to do that. But what are we using the AI tools generally in our research is to get some inputs from the AIs on a quick basis about a lot of companies, and then going and doing deep work. Like now, the AI tools help us getting to know real time basis what stock exchange disclosure may have come in any stock, or an AR report analysis in quick snapshot basis, or even the earnings call on a quick snapshot basis. But that doesn't mean that we just depend on that. We in fact, look at it as a basic input and then try and go deep work. But on the technical side, I am afraid I will not be the right person to help you.
Great.
No problem.
So
संदीप
Abhisar,
भाई आपका कोई
thanks.
संदीप भाई का कोई इनपुट हो तो
नहीं, input है, but not worthy of your time. So I think whatever Abhisar says, I'll just leave it here.
Great. Thank you. Thank you. So Abhisar, thank you so much for taking out time today. It was a lovely interaction, and I sincerely believe our audience also enjoyed the same. And thanks, Sandeep, for chipping in and adding perspective and great set of questions to Abhisar. So for our audience, they can definitely connect with Abhisar Bhai, and so that we can